The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is Research Director Nathan Bell. Hey, Nath.
Hey, Gaurav.
We don't often get you on the podcast, so happy to have you here, Nate. Thanks for your time.
No, I've been addressing the huge crowds at the ASX investor events on the Saturday at 3 p.m. Perfect timing. It's right before everyone goes to sleep after their coffee and biscuits.
Look, we'll come to that in a second, actually, because there was something very surprising I wanted your comment on, but we'll get to that in a second. Let's just introduce our analyst, Nick. G'day, Nick. How you doing?
Good, thanks. How are you guys?
Not bad, but Nathan's been busy. Nathan, you've been around the country a little bit doing these roadshows. I think roadshows, especially the ones run by the ASX, are always a good indication of how much interest there is in equities. I would have thought with the share market being down and bombs going off everywhere and the headlines being quite negative, that share market investors would be a bit shy. But you've seen pretty big crowds turning up to these ASX events.
Yeah, the one in Melbourne in particular, there must have been at least 500 people, I reckon, 400 or 500 people on. By the way, I'm terrible at guessing crowd numbers unless they're at the MCG and the Hawks are playing. But to see so many people there tells me that people are still genuinely interested in buying stocks. And I actually thought because there's some sort of a lot more alternative stock market related things to go to, and got Livewire these days, for example, that does its own events. I thought maybe after going to Brisbane, where there was lesser numbers, that maybe those other forums were pulling in more people, but Melbourne changed my mind because it was a big crowd there, and we got Sydney this week where they're expecting. They say there's 1,000 people coming, so I expect that there'll probably be 700 or something. But to me, that's telling you that no one's shying away from stocks. And the other thing I actually quite like is, you may remember, Gaurav, that we got laughed out of an ASX luncheon sort of gig in Sydney one day. I reckon it was 2014, and I got up there and told everybody that the salad days for the banks were over. And I remember getting heckled and people laughing, and people yelled out, yeah, we've heard it all before. And here we are a decade later, and there's basically been no capital growth in those businesses at all. And actually, if you look back 20 years, some of those banks have produced no capital gains, and all you've got is a dividend yield. So when I've been talking about my couple of small cap stocks that Intelligent Investor members will be well familiar with, so there's nothing to talk about there, they've actually been nodding their heads when I've been poo-pooing the banks and owning a portfolio like the index, which is basically just the A-REITs, the iron ore miners, the banks, and CSLs. I think it's about a 6 or 7% weighting in the index. And people have finally realised that after 16 years of no capital gains, that you can't just focus on buying those big companies and collect the dividend and expect you're going to do great. I still think it's incredible, and I sound like a broken record, but I'm amazed the bank's returns have been so poor when we've been through the most incredible mortgage and credit and housing boom ever in history. And the returns are still poor, which just shows you that you've really got to focus on the industry trends, not the macro environment. You can't just buy anything. Price matters, all those things. And so to be actually seeing people, 500 heads, bobbing up and down and agreeing with me when I'm saying these things is actually really unique.
I wonder if that means we should be getting back into the banks now. That worries me. Whenever we're faced with a consensus like that.
Well, funnily enough, I have been thinking about it and looking at them, and I don't know how much more damage the competition can do over time, but obviously you haven't got the big tailwind from just massive refinancing, which is sort of starting to slow up. Bad debts are fine. It's finger in the air stuff as to how bad they get, but it's hard to predict a massive meltdown, and it's pretty unlikely. But it's more just about the net interest margins, I think, and it seems that the war for refinancing is starting to slow a little bit, and you have got higher interest rates, and obviously banks are slower to pass higher interest rates on through their savings, so they do get that margin uplift. But the competition from Macquarie in particular, and now some of the neobanks and overseas banks are starting to come back. You're actually not seeing those sort of high net interest margins anymore. They're staying flat for other reasons, contrary to history. So, but they're what the banks are now, to me, is their utilities. Their return on equities have come down to more something like a utility, and that's exactly what they should have always been. All they do is they're essentially just giant, sort of not ATM to reverse ATM. You're sort of just sucking in all this paperwork, and it's not like people are really sitting there analysing all these home loans. It just goes through a computer and it ticks the boxes, and that's all they do. So essentially the whole thing's automated. So there's no reason why the return on equity should be 17 or 18% for these types of businesses, and also they're still priced pretty keenly. I know the prices are down from where they were, but there's pretty good reasons for that.
Now, speaking about machines and AI, Nick, we had something quite unusual happen with OpenAI last week. The founder, the CEO, the guy who's widely credited with kicking off the AI boom was sacked. Can you just let us know what happened there? And did I hear correctly that he ended up at Microsoft now? And what does that mean for Microsoft?
You did hear correctly that he'd been offered a position at Microsoft, but he's actually now been reinstated at OpenAI.
Oh, wow. Okay. What a circus.
Been an absolute, circus.
So he was, why was he sacked? What happened?
Oh, the board offered this pithy excuse that he wasn't communicating properly with them, but it just seems extraordinary. I mean, this is a guy that's led a company that's created ChatGPT, the generative AI engine that's the fastest growing company to 100 million users in history. It was only launched a year ago. It's really responsible for us talking about artificial intelligence today and all the investments companies are making. And to fire him only a year later just seems incredibly short-sighted. But it's a really interesting thing to look at the corporate governance here and have a little think about that and what that means for investors. It's really a mundane and boring issue and becomes a tick-the-box sort of exercise, but it can really destroy value in a lot of cases if it's not implemented correctly, and that appears to be the case here. So OpenAI has this unique board structure where it's a non-profit and 6 board members essentially run the company. And 2 of those were Sam Altman, the co-founder, and Greg Brockman, the chairman, who were just fired by the other 4 without any notice. And they then had
both of them were fired, were they?
Yes, last Friday. Yeah,
Okay.
Yeah, one of the board members, I think, called or set up a Zoom or Teams call with them and pretty much fired them. And so underneath this sits a for-profit company. And so Microsoft owns 49% of that and has invested $13 billion. It's last valued at $90 billion. They weren't consulted with the decision. They didn't know it was coming. So this one decision could have blown up the entire $90 billion valuation of the company because 750 employees signed a letter saying they'd quit. And that's the entire workforce. It was just incredible. Yeah. I've never seen anything like it, really.
And so Microsoft initially had agreed to hire Sam and the other bloke as well. I'm not sure about that, but then you're saying they're both now reinstated back in OpenAI. Now nothing has changed. We're back where we were on Friday.
Changed.
Okay.
We are, except those board members that revolted or led the coup are now gone.
Yeah.
So they've retired.
Oh, they're gone. Right.
They're gone. Yeah. Microsoft also offered to hire anyone else from OpenAI that wanted to leave at the same compensation rate. So it was pretty incredible.
That's incredible. That is incredible. Yeah. What a circus. Yeah. I'm surprised that Microsoft, with such a large holding, wasn't able to exercise any control about what happens over there. Generally, you see, if a shareholder owns 49% of the business, they have some sort of say about who the CEO is and what happens with those big decisions, but not in this case.
No, and that's that non-profits. It's very unique structure, and once a non-profit board's in, actually, there's not much you can do to actually remove them. It's incredibly hard. There's no AGM vote, and we're going to vote the director off and change all this stuff. It's really hard, and so Microsoft didn't really have a lot of legal options either. It's just their only other option was to hire all the talent and write that investment off, essentially. it's kind of amazing that a company that's the second largest in the world would, make an investment under this governance structure, but it sort of highlights, I guess, the opportunity of artificial intelligence and get in at any cost and not worry about that sort of stuff.
What really surprised me, Nath, I don't know if you've come across it before, but the importance of particular individuals in some of these new technologies has really surprised me. I don't think we're used to thinking about technology with individuals playing such an important role. And this one, Sam appears to be absolutely instrumental in the running of the whole business. I mean, the entire workforce revolted. Are there any lessons from that with the ASX? Do we not pay enough attention to individuals in charge of companies?
Yeah, look, it's interesting because the way I look at this is we're always looking for these founder-led businesses because they have such a great track record over time. And I think it's still one of the last remaining reliable free kicks. Obviously, doesn't mean you can buy any company with the still founder-led. Obviously, Jerry Harvey Norman's one of those that we certainly haven't bought and doesn't fill you with comfort that he's still running things, even though he's not officially the CEO or anything. He hasn't been for years. His wife is.
I do remember, Nathan. I don't know if you remember that. Do you remember when when he called you? Nathan had written this article saying that Jerry Harvey was no longer fit, and where things were falling apart at Harvey Norman. And Jerry called Nathan, and what did he say? Those first words he said to you on the phone, just hilarious.
He said, "So you want my job, do you?"
And we all wondered, what would it look like? What would it look like with Nathan Bell in charge of Harvey Norman? There'd be AFL stuff everywhere. The whole place would be turned into a football store.
Yeah,
PlayStation's no more.
The funny thing is, I'm sure I've seen video before. I can't remember what show it was on, but he was talking about. I actually can't even remember what he was talking about. And I'm sure he had that article printed out and pinned up, and I think he actually reached for it or pointed at it in his office.
Oh dear!
And he said, "See, like people trying to sack me. I knew he was pointing at our article."
Oh dear!
The other thing too, I'd add to this too. On the ethical front, you're seeing, and we're going to talk about Lovisa and board goings on and CEOs in a second with you, Gaurav. One of the big ESG things is about ticking all these boxes about having a certain amount of independent board members, having a certain amount of female board members, and all these types of things. And yet, one of the reasons why I think the founder-led businesses have worked well, or at least the ones that have worked well, is that they tend to surround themselves with good people who buy into the culture. And the problem with the box ticking is you're bringing people in who might be independent, but they don't know anything about the business. They don't buy into the culture. They don't buy any shares. So, I really think there is, I was going to say it's a big risk, but it's actually already happening, is that there's just all these people trying to earn a living out of ticking boxes on this ethical and ESG front. And I think that's a real shame because it's not adding value at all. And I think it's actually working the opposite, where CEOs and important people in businesses are starting to get upset and annoyed because they can't get remunerated properly because these box tickers see something that's unique or different, or maybe they just don't like for some particular reason. And yet you don't see any of these people buying any shares in the company, and they've been some of the biggest value generators for shareholders, and still long ways to go, decades ahead for these great businesses. And then people trying to stop that, just because they're sort of looking after their own little part of the world and trying to make themselves important. And it's really something I'm really trying to rally against with our ethical fund.
Yeah, I was at a lunch yesterday, and a fund manager had joined us. And he mentioned MinRes, and he was saying that Chris Ellison, the founder and CEO of MinRes, gets into more trouble with the Australian Shareholders Association and those corporate governance types, because he breaks pretty much every rule of corporate governance. But the success of MinRes is founded on him actually breaking all those rules. Like, you wouldn't have the success without the rule breaking. So you're in this weird situation where the governance hawks are criticizing the CEO for taking measures when those measures have actually led to the success of the entire business. So it really is a great example of bureaucracy and box ticking taking priority over results and action. And but it shows you how rules sometimes take on a life of their own, and they become the goal for the sake of their own sake.
The thing here too is like we're not talking about doing anything illegal or hiding things in the reports or anything like that. All we're talking about is just these arbitrary sort of ideas or numbers of people, sitting on a chair. It is ridiculous even when you start to think about it. But can you imagine building a $10 billion business from scratch, not raising capital? I don't know what mid-res market cap is at the moment offhand, but just, these are the size of businesses that people are building and bigger. And then you go to the AGM and you're going to talk about another great year. And this is like year 19 that you've been doing a great job. You've got all these great staff. You're investing your profits, reinvesting in the business. You've got all the future to get excited about. And then you've just got all these ESG people sitting there telling you doing all these things wrong and striking your remuneration and stopping you from incentivizing other staff members. I get why these people are frustrated. And sometimes I think when you see these people in the media, for example, or anywhere and they're frustrated, it always plays badly. You always it just looks bad when people get frustrated. But I get it. You're 55, 60 or, whatever, and you've been building this business for 20 or 30 years and everything operationally is going great and you've been one of the stars of the ASX. And here's these little crop of white-collar workers coming in with their little clipboard and ticking these boxes and telling you what you've got. It's absolutely ridiculous.
I don't know if you guys have seen the movie Ghostbusters, but that scene in Ghostbusters where the guy from the EPA is trying to shut down the ghost jail where Bill Murray's character has kept all the ghosts, and he shuts it down, and then everything goes to crap. There's mayhem everywhere, and then that all happens. I always think about that scene whenever I see a guy from the ASA or some other government's person pop up at an AGM and complain about something that's going on. Like, they just don't understand what's happening, and they're pointing to their little rules and saying, you've got to do this. I remember being on a TPG annual AGM, and there was another guy. I am going to pick on the ASA because I think they're the ones who are often at fault here. The guy from the ASA stood up and said, "Oh, David Teo is both the chairman and the CEO. That's wrong. And there's not enough women on the board. And David Teo owns too many shares and he dominates it." And you could just see everyone in that room turning around thinking, "Mate, you've got this all wrong." It was just a classic case of a pinhead coming in and having no idea. He's that bloke from Ghostbusters. That's who he is.
It always seems to be these founder companies too. Dicker Data's another one with David Dicker.
Yeah, Dicker Data's a great example.
Yeah, voting down the remuneration there before.
Yeah.
It's a nice segue, Gaurav, to the Lovisa AGM that you went to, and I know you're going to write an article about it anyway, but I did see the headline that Brett Blundy had to get in and defend the CEO's salary.
Yeah, this is a tricky situation because, I think I've said this many times, but there are, in most cases, following the rules leads to good results, but there are some cases where breaking the rules leads to the best results. And I think that's what's happening here at Lovisa, because if we were looking at the report of any other business, and this is a $2 billion business, and if we saw that the CEO is earning sort of $30-40 million a year, and I think his ultimate package is sort of $70 million a year over a couple of years, I think our reaction would be, hang on a second, that doesn't seem right, that seems excessive. But when you look at the specifics of what's happening in this case, I have no problem with it. Lovisa is my largest holding personally. We hold it across the funds. It's a business we've been enthusiastic about for a number of years and has done very well for us. I have no problem with the remuneration structure. Brett Blundy, who's the chairman of Lovisa, owns a 40% stake, and I think he said in the meeting that I'm paying half the salary. It's coming out of my pocket, and I'm okay with it. That sort of shows that the person who's most invested in the business, who has the most to gain and the most to lose, is the one who is the most comfortable with the current arrangement. And that's because the CEO, Victor Herrera, I think I've got his name there, right? He's an exceptional individual. I must admit, I raised an eyebrow as well, but having gone to the meeting and heard him speak a couple of times now, I'm just incredibly impressed with that CEO. And he's funny because he doesn't come across. If you I don't think I've ever come across someone who is so unimpressive after 5 minutes, but is incredibly impressive after 30 minutes or 1 hour. He's quite low key, but then when you get into ideas with him, we had a really good chat with him after the AGM a couple of days ago. You learn that this is a deeply impressive man. He rolled out 600 stores in China, lived in China, speaks fluent Mandarin. He says his Mandarin is better than his English, understands this company really well, understands that country really well. He spends about 250 days of the year in overseas locations, visiting stores and doing deals, flies economy in every flight he does. Brett Lundy kind of joked that everyone who works at Lovisa hates Victor because he flies economy. It means like they can't fly anything other than economy. But they love Victor because he gets stuff done. And there was a question, we were talking in a group, a couple of us, and someone asked him a question about a store in Paris. He said, look, I was in Paris. I was looking for this store you just opened. I couldn't find it. Has the store opened or is it closed? And Victor straight away gave him step-by-step directions about how to get to that store, with the consistent with the story. This is a company with 840 stores. He knew exactly what store I was talking about, knew the exact location of it and how to get there. This sort of detail is really impressive. To do what Lovisa is doing and to roll out hundreds of stores requires a unique amount of dedication. And I have no problem with paying someone a lot of money to get the result that we're after.
I think the longer term targets to get to the 70 million, they're pretty aggressive. I think it's more what's a little bit shocking was how much he's earned in the short term, but because he had such a good job, was it Imdex or was Zara one?
Inditex.
Zara. So I've mixed it up with the other company, but to get him out of there, where
he's the mining services firm.
not quite the same.
That would be funny. Not quite the same. Yeah.
It wouldn't be me if I didn't mix up some names. To get him out of there where he had such a good situation already, it was always going to take money. So it's sort of not like he was getting paid necessarily for the performance early on at Lovisa. It was more just you had to pay him a decent pay packet to get him out of there, and then you'll see over the next few years whether it was worth it.
And I was one of the things that really shocked me about the meeting was that this is a $2 billion business. I think it's the best retailer on the ASX, and there was probably about 30 people there, and maybe a quarter to a half of them were auditors, staff, officials. So this was a very poorly attended AGM from a business that's $2 billion and probably the first retailer to complete a successful international rollout in Australia. I'm surprised by the lack of interest. I would have thought there'd be far more interest in a business like this. Nick, do you ever use that? I mean, that's actually one of the key reasons I like to go into AGMs. I want to see who else turns up. Are there fund managers there? Is there media over there? And just how many people are interested in this little story?
Yeah, it's something I learned pretty early on. I went to a conference. It's a small cap conference. I think it's run by perhaps Macquarie or Goldman Sachs. And I was sitting next to an investor, and he was just jotting down how many people were in the room for each presentation. And it was really quite interesting. And he sort of went over, and he knew I was young and probably inexperienced, and sort of said, "Oh, I like this company because only 12 people came, and that was the lowest of the day. So that's where I'm going to spend my time." I was like, "Oh,
that's interesting.
Pretty informative." So yeah, no, it's definitely something to notice. And I think with AGMs particularly, you can catch management a bit out of their usual corporate spiel. Instead of investor presentations or after results where they just say the same thing over 3 or 4 days to hundreds of people. So yeah, no, I think they're incredibly important.
I'm quite new to them. Nathan, in the past, we haven't gone to a lot of AGMs, and you and I certainly, we've been working together for 10 years, and we haven't gone to many AGMs together, but I've come around to AGMs. I'm quite willing now to travel and to spend time going to them. I think the small things you pick up are really, really important, especially if you have a significant position size in the stock. one of the things that I found interesting is that Victor was wearing Lovisa jewelry to the AGM, and he made a point of kind of showing everyone. He gave some of the guys the jewelry for free.
I assume it wasn't earrings and a necklace.
I was going to leave you to guess what it was. No, it wasn't. He had some bangles. He had a whole bunch of bangles up his sleeve, and he was wearing them. I remember I saw this when I was dialed into the Aussie Broadband Investor Day as well. It was their first Investor Day, and what was really interesting was that the entire team came dressed in uniform, and it wasn't just the CEO show, even though the CEO is the founder, major shareholder, could have very easily been the CEO show. They had people from across that business, and you could just see the depth of knowledge and expertise, and you only really see that in these face-to-face interactions. So yes, Nathan,
I used to go to
them. We should go to more.
I used to go to them religiously when I first joined Intelligent Investor. Greg always loves to them, and I'm assuming you're with him there yesterday.
Yeah, I went with him.
And so we went to a lot, and particularly when I was learning about new businesses, because basically every business was essentially new to me in some way back then. I wouldn't miss one. I'd go to all of them, and I'd go every year. Basically, it was sort of reporting season, and then a couple of months later, it's an AGM season. So you're back going into them, and it was fun, going around with Greg and learning from him and seeing what he liked and what didn't like, and catching up with some small companies he didn't know much about. It's obviously not as fun going to a Woolworths AGM and stuff, but where they just sort of, point out what the like sales were and all that sort of stuff, and whether the dividend's going to hold up. There's some where, and pre-GFC, they were awesome too, because like the Macquarie one, there's like a Simpsons episode where Homer has a dream and he goes through Candyland and he's eating part of a dog and a house and stuff. He's just taking a chop. Well, I swear when he came out of that meeting, because I had to run out early one day, so I came out and I was the first one that came through, and I just grabbed all these cream cakes and things. Like it was a lay-on, I don't know what's the word, a luncheon like you've never seen. The quality of the food and how much of it was incredible, and I just went for the desserts, and 10 minutes later I had a terrible pain in the guts for whatever meeting I was heading off to. And then the GFC come and they really changed. They really sort of shut up shop, and it wasn't just the the expense and sort of the lavishness where they were sort of almost trying to not con investors, but make them feel good about owning the shares and whatever through means other than the performance of the business. You really saw a change in attitude from the management and the boards. A lot of them were under a lot of pressure through the GFC. Macquarie was a classic one. It's a company that people can't say more nice things about these days, but in those 2 or 3 years during the GFC and afterwards, like no one could say a good thing at all about it, just why the share price was in the teens. So they have changed. And I think the couple of other things that have changed is one, you can watch them online, most of them these days, so that if you can't get there, because a lot of them are obviously in cities that you're not in, so it's a bit of an expense and a lot of time to go to different ones. So hopefully you can log into them. And the other thing too is, not to say this will sound a bit horrible, but there was a guy who died a year or two ago who used to just take over the annual meetings, and he really ruined the annual meetings for me, because he was just trying to get attention himself, and it was bad enough just him alone, but when you've got a couple of people applauding him and patting him on the back, and like it just turned into a circus, so you weren't learning anything about the business. And like, I'm all for people who want to keep boards and management accountable at the annual meeting, and like that's absolutely what they are there for, but there's still a professional way to go about it, and it's not about drawing attention to yourself. And this guy was just trying to be a comedian. I can't actually think of his name, because I'm sure a lot of people listening who've been to AGMs would know his name, but he would suck up half an hour of just nothingness in a short time of period, so there really wasn't any questions left or any time left to ask any interesting questions. And by that time he'd already pissed off the board and the CEO and anybody else was there and most of the crowd, and so people had enough and just wanted to shut him down and move on. So you really missed out on a great opportunity to learn something about the business, all from this one individual's behaviour, which I think spawned similar behaviour from other people. So that's another reason he's not at these big AGMs anymore, where he probably owned 50 shares in each business just so he could go and be the comedian at each AGM.
Yeah, the boards are really strict on that stuff now. I was at the New Hope AGM last year, and geez, you don't want to be a clown at Rob Milner's show, because He was very, very strict at shutting down any sort of funny behavior. The other thing I wanted to point out was it's a good opportunity, the board together. And, I know we all like to think we're experts at judging human behavior when it's right in front of us, but it is the only time we get to see how these individuals who are really in charge of these businesses we're shareholders of interact with one another. And sometimes you learn something and sometimes you don't. I'll point out two things, one about Lovisa, one about MinRes. Lovisa's board is they're clearly a bunch of individuals who work very well together. They were extremely relaxed despite the share price that had fallen by 25% over the last 12 months, and same-store sales that were down. They could have very easily been defensive, and they just weren't. They clearly got along very well. It's a board that works well together. I have seen boards where individuals just do not speak. It's just the chairman who speaks and no one else says a word. And there's tension between everyone, and you can see it. I want to contrast that to MinRes, who also has an excellent board, but just a very different vibe coming from that business. You can see that business is Chris Ellison. He dominates that board and that company in a way that I don't think I've seen too many ASX listed companies. So you know that when you're investing in MinRes, you know the guy in charge, you know the guy who calls all the shots. It's Chris Ellison. Whereas, Lovisa, you got Brett Blundy there with a 40% stake. He's clearly the man in charge, but this is a very collaborative effort, and I thought that was quite interesting. Nick, can I have one board anecdote from you, and then we'll try and move on.
I might end on the corporate governance issue that I brought up with OpenAI and just an example of it done incredibly poorly in a public company. And that company's Boeing. When they had that 737 MAX disaster, obviously a lot of attention was drawn to the board. And it's coming out now that of just the complete and utter lack of culture around safety that this company had. So the board had no safety mandate. They found out later that the employees had a safety review board. So the board was completely unaware that existed. In the board meeting agenda after the first crash, safety wasn't discussed. The safety wasn't an item on that in that meeting. And then, the CEO left with a severance package of $80 million. That chairman that led the board during this time is now the CEO of the company. And it's just, the shareholders are now suing the board for what happened. It's just incredible. And I think we sometimes think about these things as, it can't happen. Like they would have ticked all the boxes and everything's kosher, but it's not the case, and you've got to do the homework. And for Boeing, one of the signs was there was hardly anyone on the board with aviation experience. They were all ex-government employees that were just there to collect the paychecks, really.
And that's a business that was universally regarded as a high-quality business. No one would have guessed that there were governance issues unless they had specifically gone and looked for them. That's a really good example.
And they're selling. And what they sell is reliability and safety, really. Yes, they are selling transportation, but that's why people are happy to get on these and why there's only 2 of them and not 500 of them. Because if something goes wrong, 37,000 feet in the air, it goes horribly wrong. And, it's just incredible that there was no, safety culture in this company at all, and nothing at the board level, or no oversight at the board level.
Now, Nath, before we, let's stop here for a quick break, and we'll come back for one final segment.
If you like the sound of our investing approach but you're not yet a member, visit intelligentinvestor.com.au and take a free 15-day test drive of our membership. You'll get immediate access to all our current buy recommendations, model portfolios, and engaging educational research, tailor-made for people who want to manage their own money. That's intelligentinvestor.com.au for a free 15-day trial. No credit card required.
Nate, if you had asked me any period over the last 10 or 15 years who my favorite investor was, I would have said Jim Chanos. He's the one I admire the most because he has a tough job. Chanos is perhaps the most famous short seller in the world. He's famous mostly for cracking Enron before anyone else, but he's cracked a lot of difficult short cases. Wirecard was probably the most recent one. Famous for doing really in-depth accounting work, unconventional research, and then being extremely hard on his targets and public with his research as well. But things have not turned out very well for Mr. Chanos over recent years. Nate, give us an update.
No, I should add too, I've seen him present a long time ago at a conference, and I've watched a lot of interviews with him, and he just seems like a really nice bloke as well, which you don't often see with very successful hedge fund managers around the world. And you always, everyone who talks about him always talks about him in a really positive way, either through they've worked for him, what they learnt when they worked for him, or whether it's just being friends with him as a fellow investor or whatever. Everyone speaks so highly of him. I've never heard a bad word said about him other than from CEOs who have been busted by him.
I was going to say, you haven't been talking to enough CEOs. The CEOs hate him, absolutely loathe him, which is why we love him, right?
To maintain your conviction as a short seller publicly on a lot of these things is extraordinarily difficult, and the payoff really isn't very big. Like a short book for most people might be 40 or 50 stocks with like less than 0.5% position in them, because if one of them just happens to go up, and they can go up for any sort of crazy reasons. Imagine being short GameStop and went 100 times or whatever it was. Like any one position can almost blow you up. So it's a hell of a lot of work, a lot of stress. And what we've probably found is just to prove how difficult it is. I think if I've got the number right, he had $8 billion of FUM under management during the GFC, when obviously the shorts would have been paying off at their most, and people were very frightened. So they were definitely after his services. And last week, earlier this week, he announced that he's closing down his hedge funds with US $200 million in them, which I thought was astounding to think that we've got more in Aussie dollars at least. We manage more money than that, and this is like a titan of an industry, and it just shows you how tough shorting is.
Nick, did you have much to do with Chanos? Did you follow him? Are you interested in shorting?
I'm not too interested in shorting, but I have followed Chanos, and I agree with Nathan. He comes across as really nice and presents the theses, I think, quite objectively. I mean, he was one of the first also, I know you mentioned Wirecard, but raised a lot of issues about Alibaba and the corporate governance there and how this didn't work. And that's when all these other fund managers were like, China's the next big thing. This is the Amazon of China. It's that easy. And he was like, hang on, you might not actually own bits of this company. And it was right. And look, he probably didn't make any money off that short. And that's one of the reasons shorting's so hard. And I know, I think John Hempton, the famous Australian short seller, said that about Wirecard as well, that it's his biggest loss ever, even though his thesis was right, because he was wrong with the timing, and it went through 100 before going to 0, and so it's a hard business, but I guess some CEOs will be probably happy to see him shutting down. I guess.
I think it's still like for a lot of investors. For a lot of investors out there, the idea that you can protect their portfolios from losses is still really appealing. We don't hear, I haven't heard it a lot or at all for a long time from any of our members, but people would be asking regularly about stop losses. Can I put them in? And they've never made sense to me, because if you bought the right business and you bought the right price, then I always used to think it was bound to, the share price was bound to fall as soon as I bought some shares. I felt like that for the first 10 years of my career, and now it's happening again. And so you never know what the path is. But as a long only investor, like the most you can lose is whatever you invest, whereas on the short side it's unlimited. And the thing is, it's really only probably once every 10 years that being short the market really pays off. So to have that front of mind all the time, it's really stressful. And you just put a lot of, intelligence that could be in time that could be used elsewhere to find the next WiseTech or Xero or whatever it happens to be, which pays off massively and doesn't create the stress that the short stuff does. So it never appealed to me from the start. We know the market goes up over time. Timing is your friend when you're in good businesses. And then when I realised as a professional and learned more about how people did it, including from John Hempton, about just how many companies you had to own and just how much time is involved in it. Like the thing I loved about investing was you find the good business and it does all the hard work for you. And if you don't like management or something changes, well, you just hit the button and you sell and you move on to the next one. But shorting is like the antithesis of that. It's the complete opposite. It's massively time consuming, massively stressful. And I think, it doesn't really pay off. I can't really think of, Jim Chanos was probably the person you'd put out there as being the most successful at it. And he's closing his shop. And you could make an argument that it's cyclical. Are we at the end of this incredible, cheap money bull market and all the rest of it? And maybe that's what it is. And maybe over the next couple of years, it'll pay off for him because he's opening a family office anyway to manage his own money and a few close friends by the sounds of it. But one thing I have noticed in the last probably 10 to 12 weeks is I have a spreadsheet with a list of esoteric overseas listed stocks. And they're just stocks I've picked up from fund manager letters over the last probably 5 years. So they're not thematic or they're not big stocks that anyone would know or anything like that, but there is a heavy concentration of tech stocks in there. And I've just noticed, up until the last couple of weeks where a lot of them have started to recover or prices are going up, is just those share prices finally cracked. It wasn't last year when we sort of had that first down move in the market. It's taken a couple of years now where things are finally starting to slow down and the revenues are falling, and now they've got a lot of debt that needs rolling over. And you can see these things are actually going to be basket cases. And it's taken a long time. We're nearly 2 years into this, this adjustment, let's say, of higher interest rates. And even the worst of these worst businesses are only just starting to crack. So it tells me that this, maybe the short sellers will be putting out some decent numbers from this last quarter. But even in saying that, there are still all these tech stocks, which I think call the second liners or the pretenders, which are nowhere near as good as, nothing as good as like Microsoft and all these great companies. These are the pretenders, but they're still sporting market values of tens of billions of US dollars. And so I don't really think this growth stock phase or craze, if you want to call it that, is going to end until all those businesses are cracked. And the fact that Cathy Wood is still getting invited to seminars and still talking about ARK despite her horrendous returns tells me that people are still punting on these things. And again, you mentioned at the start, Gaurav, about how many people are attending the ASX investor conferences. It tells me people are still up and about. Everyone's got their jobs. People are still speculating. So that, the end of free money and all that really has had very little impact in the Western countries so far. And there's still a lot of stupidity around.
Geez, that's a horrendous note to end on. So I'm going to add one more thing to it. I love that point, Nath, about the magic of investing. I really felt that yesterday at Lovisa. Now, I was listening to the management speak about all the effort they go to about opening these stores, how much effort goes into designing them, the hustle it takes to move inventory around the world. And these guys are in 40 countries and they have to open, between 150 and 200 stores a year. And there's so much work, tens of thousands of people involved in doing it all. And here I am, able to put money in, sit there, drink my coffee, let them do all the hard work and earn the returns of their labor. And if that's not magic, that's the brilliance of investing. And we're lucky we get to do it. That's why I would just, as much as I admire short sellers and I appreciate the rigor in their craft, I would never be one myself. It just makes no sense when you can sit back, buy a stock and let others do the work for you.
A Lovisa customer told me the other day that the shopping centre she was in, there's actually 2 Lovisa stores. I can't think of any shopping centres where like a brand or shop has had more than one store in there, which just shows you how profitable they are and how much foot traffic they bring in.
In the QVB in Sydney, there are 2 Lovisa stores within probably 50 metres of one another. And the average revenue per store in Australia is $1 million. So if you believe the numbers, each of those stores earns $1 million of revenue a year, and they're 50 meters apart. It's incredible.
Well, it's amazing because we were here, everybody was worried about Domino's strategy in Australia about, I can't remember the name they had for it, but basically adding more stores in areas, fortressing. Sort of putting, just basically flooding areas with more stores. And it's like, oh yeah, but they're so close, and yet here's Lovisa, like 50 meters away in the same shopping centre. It's amazing.
To be fair, that is rare. They don't do that everywhere, but yeah, that's amazing. Right, well, we finished on a high note. Happy to hear it. Gents, appreciate your time today. Nathan, thanks for your time today.
My pleasure, Gaurav. And can I just say this will be our last recording for the year because we've only got a few weeks left before the office closes for Christmas. So first of all, a thank you to everybody who watches and all our subscribers and investors. It's been a tough year, I think, in some ways. Frustrating because I think we've got some great recommendations out there and some great undervalued stocks in the portfolios, but the market really doesn't seem to care too much at the moment. But also thanks to you, Gaurav. I don't think people, or certainly people, underestimate both within the business and externally just how much effort you put in to these recordings. So thank you very much. And also thanks to Nick, who's been with us now for 18 months and is doing a great job on the international stuff and covering them on both here and in the newsletters. So it's I actually think this has been the best year of content for our business ever. And I was in Melbourne last week for the ASX Investor Day, and some people actually said that they thought it was the best content they'd ever seen in the business. And another guy who hadn't been with us for 10 years was asking to subscribe again. So that's a real feather in the cap to you both, and John and Graham. So thanks again.
Appreciate that, Nate. Thanks very much. And look, let me throw a shout out to Nick as well. Joined the business and just been a part of the furniture now. Bit like your much maligned filing cabinet there, Nick. You're always going to be there, and we're happy to have you. And we should also throw thanks to our producer Stephanie, who works behind the scenes to make sure we all sound good and say the right thing.
Absolutely.
Right. Gents, thanks for joining me, and for everyone else, thank you for listening.